starting in 2026, if we don't itemize on our tax return, we can take $1,000 off for charitable giving. State and local taxes, we had a cap of $10,000 that we could deduct. That's quadrupled now, so it goes up to $40,000. We believe in intentional planning, looking ahead in the future, right? So take advantage of these things. Look at your tax impact 10 or 15 years out based on current laws, and what moves could you take now with these new deductions and tax breaks to make the most of your plan.
Hello and welcome to the Relax, It's Retirement podcast with your host, Josh Leonard, where we talk about transitioning into retirement with intent. I'm Wendy McConnell. Well, Josh, I see you have a terrible towel.
I do.
Indeed, it is a terrible, terrible towel.
Well, last episode, Tom Baker was gracious enough to gift me one as a welcome gift of being back to Pittsburgh. So,
okay, all right.
I figured now that we're in Pittsburgh, you
all right.
should have something, right?
Well, you want to support your home team, and I get that, but
Yep.
Super Bowl champs right now are the Philadelphia Eagles. I'm just pointing that out.
What's the current? Yeah, okay.
We have 2. You have 6. So, yes, you've had a big running start compared to us for sure. But we're all in the same state, so we're good.
It's okay. I think we now have, one of the world's oldest quarterbacks. So, we'll see how that works out, Not
Good
my
luck.
expertise, but worked out real well for New York, didn't it?
Yes, indeed. Maybe we should just move along, though, to I don't know.
Taxes.
Let's talk about retirement.
Yeah, and taxes. That's better, right?
Okay. All right.
So recently, ironically, Wendy, we tried to do a episode here, I think it was 2 episodes ago, about, some of the recent law changes. And many times when we hear all this news of, this bill being introduced, we start to blend them together as what's real and what's not real. So we did that episode, and ironically, right as it launched, we did have a new tax bill. So today, I want to get caught everyone up on the One Big Beautiful Tax Bill Act.
Okay.
Because it's actually an act, not a bill, but that's a separate discussion.
Okay.
So yeah, there's a lot of takeaways. 6 key takeaways I have for you today, Wendy. So you read the whole bill, right?
I'm in the midst of it.
Yeah.
I've got a ways to go.
Like 900 and some pages, right?
I mean, I've read like 0, so.
We're going to that's right. Nobody wants to read these things, right?
No.
Even the people that pass them many times. So we will zoom out today, and I got 6 key areas to focus. It is new, so we are still learning and finding more tips. Some of the stuff is implemented now. Some of it will start next year. So we'll try to give you some key areas to focus on that can help people in that stage of preparing and transitioning into retirement.
All right. Tell us what we need to know.
Number 1 is tax brackets got better, but we still need a plan. So we kept that 10, 12, 22 percent tax brackets that we had. So that's good because they were supposed to revert back to the prior where the 12 would be 15%. And they got a little bit wider too. So that's good, right?
Okay.
But we have to be careful because we've added some other rules into the mix and other deductions where although those tax brackets are wider, there might be reason elsewhere that brings more of our taxable income in. So one of the things that we've talked about in the past is Social Security. Your Social Security itself is not taxable if that's your only income source, but if you have other income sources that can make your Social Security taxable. So the caution here is don't just think about the wider tax brackets as, oh, I have more space within the 12% tax bracket. Your effective rate might be higher because it's bringing in Social Security to be taxed along the way.
Okay. I think I get that.
You got it? Yeah, you got to dig into it. So
a little bit.
It's 2 different pieces, right? So our Social Security will increase up to 85 of it can be taxable. 85% of it can be taxable depending on our other income. So although we have those wider tax brackets, that amount didn't change. So we might see more of our overall income being taxed, in this case, Social Security, while still staying in that wider tax bracket.
Okay.
Another big one, Wendy, is charitable giving.
All right. Got it. Let's move on to that.
Have you heard of QCDs?
I have. They are qualified charitable distributions, and they are ways that you can take money that you are, you have to take out of your investments, right?
Yeah, I like it. I like it, Wendy.
And you can automatically send that to the charity of your choice, and that reduces your tax liability.
Exactly. So QCDs and RMDs work together, right?
RMDs. That's the word I couldn't think of.
Forced distribution is how most of us think of it, right?
Okay.
That's what it is. We're forced to take money out of our qualified retirement accounts, our 401ks and IRAs, starting at age 70 and a half. So for many folks, before they even need to take that RMD, we can use the qualified charitable distribution, QCD, to send the money to charity without it being taxable. Once we are subject to those RMDs, it reduces the amount that we need to take out. So you were spot on, Wendy. I like it. Good news is QCDs didn't change.
Okay, good.
If you're 65, though, you say, okay, well, I don't qualify for a QCD yet because I haven't reached 70 and a half, nor am I taking that RMD. So while those didn't change, we got some new charitable giving rules. So starting in 2026, if we don't itemize on our tax return, we can take $1,000 off for charitable giving. So if we give money maybe to the church regularly or the local animal shelter or whatever the cause might be, maybe we just give some money around the holidays to the local shelter, food bank, whatever it might be, we can deduct up to $1,000 per individual. So if it's married filing joint, that's $2,000 for the household.
Okay.
We had a similar version of this during COVID, where it was $150 and then $300. And a lot of folks took advantage of it. Because what happened to most of us prior to the last round of tax reform in 2017 is we used to itemize our charitable deductions, right? You'd save receipts, and then whenever you do your taxes. Well, with the higher standard deduction, that eliminated it for most folks. During COVID, we saw the first iteration of this with the $150 or $300. Now it's going to go up to $1,000. So for a lot of folks, they're able to deduct their charitable giving again. It has to be cash, so we can't be gifting stock or other things, or like clothing is a common thing that many of us might donate.
Right.
That doesn't qualify, has to be cash. But this is an above the line deduction, meaning we can still take the standard deduction and take this $1,000 deduction.
So this is something you're going to need receipts for as well, then.
You will need to. Yep, you'll fill it out. We haven't seen the form yet, but presumably it'll be just like it was during COVID, where we fill it in. Of course, you'll want to retain those records in case you're audited. But I think during COVID, we saw a very, very high use of that. So many folks were taking that additional deduction. So that's a big win for folks. If you have taken the standard deduction for the last group of years and give money to charity, you'll get a little bit more of a tax break there.
And that starts this year?
That starts in 2026.
Okay, next year.
So we can't do it quite yet.
Okay.
There is also a new AGI floor if we are deducting. So if we aren't taking that standard deduction, we're itemizing. Our charitable giving has to be above 0.5% of our adjusted gross income. So for many folks, this will work hand in hand. If we're taking the standard deduction, this won't apply at all, so we don't have to worry about it. If we are taking the standard, or if we are itemizing in this case, it will need to be our charitable deductions. In order to deduct them, it will have to be more than 0.5% of our adjusted gross income. So 0.5%. So a relatively low threshold, but again, it just makes it a little bit more complicated. So maybe if your taxes and those things were really high and you just needed a little bit more, the charitable giving has to be a bigger piece than it had to be in the past. This, again, is is a reason to maybe look at charitable bundling. So maybe we give a little bit more, like we double give for 1 year, or use like a donor advised fund that we had talked about in the past. So if we have a really high income year, maybe we utilize a donor advised fund to get a little bit more in and get over that threshold there. So charitable giving has shifted a little bit. I think for most listeners, that $1,000 deduction that we talked about off the bat will be a strategy that they can use. Now, we can't double dip on these. So if we do a QCD, we're not also using that for the $1,000. But we have an option now, even if you are younger than 70 and a half, so you wouldn't qualify for the QCD. So I'd say that is a pretty big win there for folks for charitable giving. Hopefully, it enables us to give a little bit more. The other big one is number 3, the enhanced senior deduction.
Okay.
For those folks 65 and older, with certain income limits, we can take $6,000 of an additional deduction above that standard deduction. If we're doing the charity too, we can double down on that as well. This starts to phase out for single filers at $75,000 in modified adjusted gross income, or $150,000 if you're married filing joint. This is how we've made Social Security tax-free.
Okay, so it's not actually tax-free.
It has nothing to do with Social Security. So I don't know, but essentially, we're using this additional deduction as a way to help offset the taxation of Social Security.
Okay.
This law does not change the way that Social Security itself is taxed. So there's been a ton of confusion around that. What is cool is even if you're not taking Social Security, so maybe you're 65 or older and you're still working, or you're spending some of your savings trying to defer Social Security till age 70, you can still take advantage of this $6,000 additional senior deduction. So for me, that's some planning space, right? If we think about slightly wider tax brackets, $1,000 charitable deduction starting next year, and $6,000 a piece, maybe we can look at some Roth conversions or alleviating some of that future pressure of the RMDs or position assets for the next generation. So I think there's a good planning opportunity. Now, this one is like, you got to take it before it's gone because it starts now. So 2025, we're able to do it. So our planning, time's ticking, right? We need to take advantage of it, and it expires in 2028.
Oh.
Yeah. I won't qualify for it, Wendy, ever, So, there's for the group of folks that it does apply to, don't think that you have to be taking Social Security. That would be a mistake. And you also don't have to be retired unless your income prohibits you. So if your income is high enough, then you would be phased out. But if you're married filing joint, that phase out starts at $150,000, and it's 6% of any dollars on top of that starts to offset the deduction.
Okay, so you're still going to get some of it if you're making $150,000 as a couple. You're just not going to get the full $6,000, and it's like on a sliding scale from that point.
Yeah, it starts to phase out. Yep.
Okay.
So certainly something to look at. And I would say planning-wise, this is something that we've started to go through with clients, and we've reached out via email to say, hey, you know what? You may want to look at this before the year ends, right? So maybe we could make some tax moves there. We were fortunate enough to run through a scenario with a client that had accumulated a little bit of credit card debt, trying to help out the family. And we were able to take more out of their IRAs with the new tax bill without them having more out-of-pocket lay for taxes. So we kind of kept them in the same tax position, and they were able to pay off the credit card, which was about to be like 20-some% interest. So that's a win.
Absolutely. And if you could pay off those credit cards, it's always best to do so.
Absolutely. Yeah. And the point being there, it doesn't have to be like a huge Roth conversion or something. We have a little bit more space, so let's make it work.
Okay.
Next up, we have the SALT cap relief. So state and local taxes, we had a cap of $10,000 that we could deduct. That's quadrupled now, so it goes up to $40,000. It's a lot of taxes. Mm-hmm. but it helps offset. Now, here in Western Pennsylvania, there's a smaller group of people that will be deducting $40,000 worth of local taxes. In other areas, New York, California, where real estate prices are quite a bit higher, they'll be impacted quite a bit more. So that helps. There is a little bit of fine print here. There is a phase out on this too for people with AGI between 500 and 600,000. So what sort of happens there is you hit a cliff where all of a sudden you can't deduct all this. So it really boosts up your effective rate. If you are in this category where you have really high state and local taxes, this is something you want to dig into before the end of the year to see, hey, is there any way that we could reposition some of this or try to keep income a little bit lower by maybe contributing more to accounts or pushing off deferring some income into the future.
And, just to reiterate, AGI is your adjusted gross income. So if you're making between $500,000 and $600,000 a year, this is something you need to pay attention to.
And the funny thing is of course, that doesn't apply to most folks.
To me, for sure.
But if your taxes are that high, hopefully you're making enough money.
Well,
right?
Doesn't necessarily mean that, but hopefully, yes.
Yes, hopefully. Again, this could be more limited too. So we think of one-time off situations. Maybe you have some stock options that come due or a severance package in retirement where your income all of a sudden jumps a lot higher for 1 year. We want to be careful in those situations that we can offset that, maybe once in a lifetime higher tax impact.
Okay.
We have some new below the line deductions. So, we talked about above the line with the charity. This is below the line here.
What do you mean when you say below the line?
So this is something, they don't reduce your AGI, but they do lower the amount of tax that you owe. So above the line reduces your AGI. So you qualify for more of these other things that we've talked about.
Okay.
This won't, but it still helps reduce taxes. So a new one that was introduced is auto loan interest, where we can deduct up to $10,000 of our auto loan interest, but they have to be U.S. assembled vehicles. And there's a whole bit of detail there.
Well, that counts me out.
My last 4Runner was assembled in the U.S. though, so
it's hard to understand what they qualify as. Is it manufactured in the country? What about the parts that, it's just very specific.
It has become, I think it has become a lot more diluted over the years, because at one point, I think they were saying that Toyota has actually had more parts made and assembled in the U.S. than Ford, which we think of Ford, of course, as Detroit, as an American car company.
And Toyota, it seemed like it was always a foreign car company.
Yes, but a lot of automakers have started manufacturing in the U.S. for various reasons through different tariff regimes, et cetera, et cetera. But there is an asterisk on that one. So we can deduct auto loan interest if we qualify.
Okay.
Another big one that's gotten a lot of attention is tax-free overtime and tips as well. This is probably not super relevant for those transitioning into retirement unless they're working part-time, right? Mm-hmm. If you're working part-time, maybe at a restaurant or something.
Right.
You have tips. Actually, there's tips everywhere now, right?
Right. Yeah, because, the $7 coffee's not enough. They want a tip on top of it.
Do you want a tip? So there are certain exemptions. As a financial advisor, I'm not allowed to charge for tips. So, we don't have a screen that we spin around to you and smile at you like,
right. Yeah.
Do you want a tip? And I was like, I thought I was at the grocery store. How's that a tipping thing? No, I haven't seen that. Yet. But,
not yet.
We've all seen this, right? This is a shift that we've seen kind of coming out of COVID, where there's a lot more opportunities to tip. We'll make it
and
positive.
They have that option on the screen, no tip, which just makes you feel so small.
I think the charitable piece always gets me too, like at the grocery store. Do you want to? I'm like, I like donating to charity, but I was just trying to get some food and go home. Like,
And I have my own charities that I donate to.
Yes.
And yes, I understand.
But certainly, that's a good cause. The tips here, up to $25,000 of tipped income.
Okay.
It's tax-free. That's a lot. And the phase out here is $300,000 married filing joint or $150,000 single. So that's that's a lot of income.
You can count on probably $25,000 tax-free.
Yeah, a lot of folks. That is a pretty wide range, right? Sometimes maybe if it was only capped at 50 or 75,000, it would be a lot harder for some folks to do it. But I guess to me, I think of maybe the person that's working a second job, right? So maybe it's outside of their career and they're really pushing to earn some extra money for whatever reason, right? Maybe it's to pay off that credit card, save a little bit more for retirement. I think it really helps that person where maybe their income is higher because they got a good regular time job, but they just need to make a little extra. We get a bit of a tax break there.
And does that start this year?
Yeah, that's active. So let's go.
Let's talk a little bit about the overtime because that's what my husband makes.
Yeah. Okay. So it's anything above. So whatever your base wage is, if you get time and a half, that half would be the part that is tax-free.
Just the half.
Married filing joint, $25,000. Single filer, $12,500.
So it's not all of the overtime, but
it's the amount that you get paid extra for overtime.
Okay, I understand. Yes.
Yep.
And that's $25,000 up to $25,000. And what are the income cutoffs for that?
150, 300,000 again. So
okay,
higher thresholds there too. So
hey, every little bit helps.
I think so. I think for maybe retirees working part-time jobs or getting really close to retirement and trying to pack some extra hours in, to get them to retirement, this is going to help quite a bit too. So that's an interesting one to me. I think the last one I got for you here today, Wendy, is inflation adjustments.
Okay.
And this one is going to be really confusing. So we'll just say the way that we're linking those moved from core CPI to CPI-U, which tends to not increase as much.
What's CPI and what's CPU?
CPI, okay, so we have these general measures of
Consumer Price Index.
Inflation, right? Yeah.
Okay.
Core CPI is the one that's most widely reported. There's all sorts of different versions of them, and essentially what they're doing is they're tracking a different basket of goods, right?
Okay.
Easy way to think about it, core CPI is going to grow faster on average than CPI-U. So by them switching it, it's part of the way they can pass the bill without violating our debt constraints. That's going to go a little bit slower. They'll still increase, just not as quickly. So in the future, we might see our brackets not really keep up with what we feel is inflation over time.
Okay. So what does that mean for us then?
Could be a hidden tax increase, right? If we think that core CPI is increasing at 3%, say, and it's only 2.5% for CPI-U, then over time, really our inflation-adjusted income that we're earning would not be falling into the same tax bracket. It could be bumping up into a higher tax bracket, effectively leaving you less money net in your pocket.
Okay. I don't like that one.
No.
Can we chuck that one?
It's a sneaky one. There's good and bad in everything. I think this bill in particular was extremely political. I think there's a lot in it that, folks on both sides of the aisle weren't very happy about. What we need to do, though, is dig in. It's law at this point and see how we can benefit from some of these deductions.
Plan,
right? Do we ever talk about planning?
It's come up.
Yeah. And maybe plan ahead too, right? Like a lot of these things are effective now or start to phase in next year. So it's time to adjust your plan, re-engage with it to make sure that we're taking the most of it. I think the senior deduction is going to be the biggest one for a lot of folks we work with. It's a short window. It's $12,000 more in deduction.
Yeah,
there's
good.
something that you should be doing there to take advantage of that. So it's a big win.
It's the first time I have ever wished I were older than I am.
You know, I met with some new folks that attended one of the classes that we did recently, Wendy, and they were like, well, you know what? I got bad news. We both turned 65 right before or right after the 2028. Like in 2029, they turned 65. And they're like,
That's a shame.
we're this close. And we were planning, and in their case, they wanted to retire early. So it was kind of like, that would help, right? But
right.
Yeah. I think to me, this is sort of a once in a lifetime opportunity to make some changes into your tax plan. Take advantage of these things, right?
Mm-hmm.
We don't know. They're probably going to shift again here. We've seen more tax reform and more changes over the last group of years than we have in a long time. So let's take advantage of them while they last. Mm-hmm. This could be Roth conversions, maybe selling off some highly appreciated stock. Maybe even just refilling that cash bucket that we talk about all the time, right?
Yeah.
We get a tax break. Pay off the credit cards, put some money in savings so you don't have to utilize the credit cards in the future. We want to be able to balance out all these interests and get the most out of our hard work dollars. So update your plan now. There's a lot to do here before the end of the year. It's summer. Don't worry, it'll be cold soon. So you'll want to refocus in.
How dare you?
It's been a muggy summer. So I think everyone will be happy for the first taste of fall.
I was actually in my closet today, and we're almost at August when we're recording this. I was in my closet today, and I saw the sweatshirts, and I was like, nope, don't start dreaming of them yet.
Yep. Enjoy it. Just, swim and do all that stuff while you can. It'll be cold soon enough.
It'll get here.
Yep. But that's it. We believe in intentional planning, looking ahead in the future, right? So take advantage of these things. Look at your tax impact 10 or 15 years out based on current laws, and what moves could you take now with these new deductions and tax breaks to make the most of your plan. So, Wendy, thanks for joining me again today. And we'll get you all situated here in the show notes. There'll be a link to schedule a 15-minute call if you want to dig a little bit deeper into your situation. If you like this episode and you needed some updates, share this one with a friend. We're getting a lot of questions around the new tax bill, so make sure to get it out to your friends. And if they have questions, they can reach out as well. And until next time, remember to retire with intent so you can live your golden years with the happiness and excitement you deserve.